You can earn a healthy income, carefully check your bank accounts, and still feel your financial security slip right through your fingers. That feeling is backed by hard data. According to the Federal Reserve, 35% of adults report their finances are worse off today than they were a year ago. That is the highest level of financial stress recorded since the study began in 2012. This chart tracks consumer debt. By June 2024, the median credit card rate peaked at 24.62%. Plotting the U.S. savings rate on that same timeline, it plummeted to 3.6% by April 2024. This widening gap creates a mathematical danger zone. When the cost of debt outpaces the rate of savings by this much, the mathematical foundation of household stability breaks down. Every dollar you earn comes with a trade-off. When we prioritize our immediate comfort and lifestyle, we are directly trading away the long-term security that comes from compound growth. To fix this, we need to strip the emotion out of our spending habits. We are going to run a strict return on investment, or ROI, analysis on the most common money choices we make every single day. If you want to stop destroying your own wealth, you have to learn the mathematical difference between harmless lifestyle perks and the heavy structural anchors that pull you under. Let's start with the daily expenses people argue about the most: discretionary micro-leaks. These are your $25 a week coffee habits, your streaming subscriptions, and the occasional dinner out. If you plan for these items in your budget, you are more likely to stick to that financial plan over the long term. A sustainable budget includes these enjoyments, provided they are fully funded by the cash you have on hand. Warning tone: the math only turns dangerous when these expenses are unbudgeted and placed on revolving credit cards. A $25 weekly habit represents a raw annual input of $1,300 a year. Paid in cash, that is exactly what it costs. But subject that $1,300 to the 24% median credit card interest rate, and your ROI goes severely negative. You are suddenly paying a premium for a cup of coffee you drank months ago. This high-interest environment creates a debt cycle. The interest payments eat up so much of your monthly cash flow that you are actively prevented from paying down the original principal balances. Your daily comforts aren't inherently toxic. They only become a financial crisis when you fund them with expensive debt instead of your actual cash flow. We can now look at the true wealth destructors. These are your structural anchors, usually taking the form of oversized vehicles and massive housing. Dealerships focus on the monthly payment because it masks the total cost of the asset. Financing a vehicle means paying interest on a depreciating asset, which widens the gap between the car's value and the price you eventually pay. Vehicles carry a massive hidden ROI drag. By taking out a loan, you are paying interest on an asset that is rapidly losing value while simultaneously taking on mandatory high fixed costs for fuel, insurance, and maintenance. The same mathematical drag applies to real estate. Society tells us that bigger is always better, but unless you have a very large family, upgrading to a 6,000 square foot house usually just means locking in higher monthly obligations. This visual scorecard lays out the 28-36 rule. It is a mathematical guardrail to keep structural debt in check. You should spend no more than 28% of your gross income on housing and no more than 36% on your total combined debt. Violating these percentages creates an immediate chokehold on your finances. Crossing that 36% threshold locks away your monthly cash flow flexibility, leaving you exposed if your income drops. With oversized housing, your mortgage is only the beginning. You are signing up for unrecoverable carrying costs, higher property taxes, HOA fees, massive utility bills, and constant home repairs. Structural overhead destroys far more wealth than a daily coffee habit ever could. If an economic recession hits, you can cancel a streaming service in 5 seconds. You cannot easily cancel a heavy mortgage or a massive car loan. When those structural anchors consume too much cash, people often turn to desperate measures to keep their lifestyle afloat by leveraging the assets they already have. The most common tool for this is a home equity line of credit, or HELOC. It effectively allows you to use the equity built up in your home like a credit card. The ROI on this is entirely negative. You are taking passive, safe equity that you own and converting it into active, interest-bearing monthly debt. By using your home as a piggy bank, you are directly putting your actual home ownership at direct risk. If you lose your job or the economy shifts, that debt still comes due. Then there is the ultimate debt swap trap. withdrawing funds from your 401k or retirement accounts to pay off 24% credit cards. This flowchart illustrates what feels like a highly positive ROI. If your investments are earning 7%, but your debt is costing 24%, it seems logical to transfer those funds and instantly wipe out the high-interest debt. But look at the hidden math. If you are under the age of 59 and a half, you get hit with a 10% early withdrawal penalty. You also halt the compounding growth on those funds. Once that capital is pulled out of the market, it stops working for your future self. The psychological danger is even worse. When the debt is suddenly gone, the urgency to pay it back vanishes. Without addressing the underlying spending habits, most people just continue at the same pace and quickly accumulate new credit card debt. Borrowing from your future compounding growth to fund your present lifestyle is mathematically one of the worst ROI decisions you can make. We can map an action plan based on your financial reality. This decision tree splits into two scenarios: those living paycheck to paycheck and high earners with lifestyle creep. If your budget is tight, follow Path A. Audit your subscriptions and aggressively build a 3-month buffer. If every dollar matters and you have no cash reserves, your highest ROI action right now is actually not investing in the stock market. Your priority is building that 3-month emergency buffer. That cash reserve is the mechanism that prevents you from falling into the 24% credit card trap the next time a crisis hits. If you have an above-average income but still feel broke, look at Path B. Your required steps are applying the 28-36 rule to your housing and stopping all vehicle financing. For high earners feeling stuck, your highest ROI action is shrinking your structural leverage. You simply cannot out-earn the mathematical drag of financing depreciating assets. Trading in a luxury vehicle every 3 years burns through money that should be generating passive income for your retirement. Regardless of your income, the universal rule for financial peace is this: fund your discretionary wants in cash. Keep your total structural debt below 36% of your income. Creating a financial plan doesn't magically print money for you, but it does plug the structural leaks that compound against you month after month. Run your own ROI numbers. Be honest about where you are overspending. Most importantly, give yourself grace for past mistakes and start prioritizing the compounding growth of your future self.